Hello everyone, welcome to BISP Solutions. BISP Solutions is a tech company that provides technical solutions across the world. So in today's webinar, we will be understanding real case studies of companies which we have already discussed in our previous sessions also, as we are taking data of companies. Real data was there about income statement, balance sheet and all. So today we are going to break down complex valuation concepts into simple real-life examples. So we will see today how to evaluate a company like Eicher Motors, not just through spreadsheet and formulas, but by comparing it with its industries like Maruti, Tata Motors and Hero MotoCorp using common sense approaches, right? So we will explore key terms like EV upon EBITDA, which we have covered in our previous session, PE ratio, which we have already covered in our previous session, and revenue multiples, where we understand what they mean, why they matter, and how investors use them to decide whether a stock is overvalued, undervalued, or fairly posted, right? And don't worry, even if you are not having keen knowledge of what we are understanding, so learn it and practice it, then you will be having a clarity that what we are understanding today. So in today's session, we will guide you step by step so that you didn't get confused in any step, right? So let's get started. So in our previous session, we have learned about relative valuation, price to earning ratio, enterprise value to EBITDA, price to book ratio, EV upon sales, dividend yield, buyback yield, total shareholders return, beta, and regression approach to beta and bottoms up beta. So in our previous session, we have made DCF model. So for analysis of the DCF model, which we have prepared in our previous session, so this is what our previous session of DCF modeling consists of. So we had made our model like this. So in 2029, right? Then after subtracting 25%, which is the tax, and reinvestment rate, it is used to expand the business, we get our free cash flows to firm, which is FCFF, right? So these cash flows are discounted to today's value using a WACC of 20.04%, which we have already covered in our WACC sheet, and the mid-year convention, which is this. So, which assumes cash comes evenly throughout the year. So, why this matters? We want to know how much future profits are worth today. So, this is what our FCFF projection was about. Then comes terminal value. So it is like after 2029, we have already calculated our terminal value. So after 2029, the model assumes Eicher will go steadily by 5.38% forever, and using the Gordon growth model, the terminal value, which is future cash flow value from 2030 onwards, it will be like around 74,184.96475 crores, right? Then comes why it matters. So terminal value often contributes 60 to 70% of the company's total valuation. It represents the long-term potential of that company, right? Then comes value of the firm, which is calculation of equity value or enterprise value, we can say. So the sum of our present value of FCFF, which is 7,785 crores, and subtracting the debt from that, which is 419 crore. So we got our equity value as 40,121.57 crores. This is what our equity value calculation was about. Then when we have compared our market price, our comparison is done with our market price. So its current share price is 5393, which we have taken from our screener.in, where like this it will be shown. This is our screener.in and I have picked my share price, which is 5525 of today. I have taken it for yesterday. So if I take it like 5525 as of today, so the discount or premium will be changed to 2.78 times, right? So this model's valuation is 1463.39. So this means the stock is overvalued by our 2.78x compared to this DCF estimate, right? So FCFF, which we have done over here, is profit left after paying costs, tax and reinvestments. Terminal value, which we have calculated over here, is our value of future profits after 2029 forever. WACC is our minimum return expected by both lenders and investors, and our mid-year convention, money comes in gradually, not at year end, right? So after that, equity value, which we have calculated over here, is this. Equity value per share is 1463.398. So this is what each share is truly worth based on business performances calculated, right? So if we do comparison of these model, so Eicher Motor is projected to grow rapidly in profits over the next 5 years. However, the high WACC, which is 20%, reduces the value of those future profits when we bring them to today's terms. So the final valuation shows that the stock price is much. So this doesn't mean the company is bad. It could mean the market expects even more growth than the model assumes, right? So after that, coming to today's topics, which are EBIT, tax rate, reinvestment rate, free cash flows to firm, present value of FCFF, mid-year convention, discounting factor, expected growth rate, WACC, terminal growth rate, terminal value, and analysis of DCF modeling and comps valuation. So we have already done our DCF modeling, and now we will be moving forward so that we will have a clarity before valuation of our relative valuation, which we will be doing with our comparing of the same industry companies, where we have already taken Eicher Motors. So we will be comparing our company, which is Eicher Motors, with different companies which are available in market for the same industry, right? So moving forward with our EBIT. So EBIT is the profit of a business makes from its core operations before paying interest or taxes. It's often called operating profit. It shows how well a company is doing its daily businesses without being affected by how much loan it has or what tax rate it pays, right? So for the same, formula is EBIT is equals to revenue minus operating expenses, which excludes interest and taxes, right? So for example, which is our relative valuation. Okay, so a small furniture shop earns around 50 lakh in revenue and spends 30 lakh in salaries, rent and raw materials. So EBIT will coming as we deduct our small furniture shop earnings and spendings from each other. So we will be getting 20 lakh, right? So in valuation, EBIT is used to calculate FCFF. EBIT is used to calculate FCFF, which is then used to estimate how much business is worth, right? So EBIT helps comparing businesses even if they are taxed differently or have different loan amounts, giving a true sense of operational strength, right? Then comes our tax rate. So the tax rate is the percentage of profit a company pays to the government as tax when valuing a business. We apply the tax rate to EBIT, net operating profit after the tax, which is no PAT, which is more realistic. So the formula for calculating tax rate is NOPAT is equals to EBIT into 1 minus tax rate. So while doing this, while you have to use this formula, right? So for the same, the example is if our EBIT tax rate is 30%, so NOPAT value will be around 7 lakh. How to calculate that? Again, NOPAT is equals to EBIT into 1 minus tax rate, right? So we will be adding 7 lakh NOPAT. So this means tax rate reduces. So using it helps us estimating actual free cash flows that can be used for growth, reinvestment, or paying investors, right? So a company with tax saving investments or subsidies might have a lower tax rate, giving it more funds for expansion, right? Next comes our reinvestment rate. So reinvestment rate shows how much of the company's earnings are being put back into the business for growth. It's an indicator of how aggressively the company is growing. So for the same, the formula will be reinvestment rate is equals to net investment upon NOPAT. So net investments include capex and changes in working capital. So for understanding it clearly, reinvestment rate where NOPAT is around 10 lakh and the company reinvests 4 lakh rupees. So reinvestment rate will be 40%. How to calculate that? We have calculated it by net reinvestment rate we are calculating. So we will be dividing our net investment with our NOPAT. So from that we will be getting 40%. So it means higher reinvestment means more future growth but also less immediate cash. So it's like a shopkeeper who invests profits in buying more inventory or opening new outlets instead of taking it home. So in valuation, it's used to calculate expected growth, right? Next comes our free cash flow to firm, which is FCFF. So FCFF is the amount of a company generates that available to both debt and equity holders after paying for operations and investments, right? So for the same, formula will be FCFF is equals to EBIT into 1 minus tax rate, which was our reinvestment rate, minus capital expenditure minus change in working capital, right? So after that, to understand it clearly, EBIT is around 20 lakh and tax rate is our 30%, and our NOPAT is 14 lakh and capex is our 3 lakhs. So change in working capital is calculated around 1 lakh. So we have to calculate our FCFF. So it will be calculated by deducting our 14 lakh from 3 lakhs and 1 lakh. So we will be getting our FCFF. So FCFF is the core input in DCF valuation. It's the real cash that businesses produce and can use to repay loans, distribute profits or reinvestment, right? So more FCFF, there is more value. Then comes our present value of FCFF. So when valuing a business, we don't just add up future cash flows, we discount them to today's value using a rate like WACC. This is because rupees 10 lakh today is worth more than 10 lakh rupees 5 years from now, right? So for calculating present value of FCFF, the formula is FCFF upon 1 plus WACC to the power n. N is a number of years, right? So to understand it better, we will take an example for the same. So FCFF in year 1 is around 10 lakh rupees and our WACC is 10%. So if we want to calculate our PV, which is 10 lakhs divided by our 1 plus 0.1, which is 1.10 to the power 1, because we are calculating for year 1. So we will be getting our 9.09 lakh rupees, right? If we do approximation, it will be around 9 lakh 9,000 rupees, right? Then coming to our, so before moving to our mid-year convention, what we are getting to understand with this example, if we are doing it for 1 year and we will do it for every year, we will be afterwards adding them all, we will get the total firm value with this formula, right? So think of it like valuing 1 rupee earned tomorrow as 90 paisa today, right? So afterwards, mid-year convention. So instead of assuming cash is received at year end, we use the mid-year convention to assume cash is earned throughout the year, not all at once, right? So for calculating mid-year convention, formula is discount factor becomes 1 plus WAC to the power n minus 0.5. 0.5 by at the end of the year we are not getting the money. We can get it in 6 months or 5 months. So that's why it will be calculated in 0.5 months, right? So for example, to better understand, if our year 1 cash flow is around 10 lakh rupees and our WAC is 10%, so if we calculate our PV, it will be coming around 9.53 lakh, which is better than 9.09 lakh from year end method, right? So this gives more accurate value, especially for growing firms that earn regularly, not an year end. Okay. Next comes our discounting factor. So the discounting factor adjusts future values to present values using WAC or a required rate of return. So for calculating discounting factor, formula is 1 upon 1 plus WAC to the power n. So the formula for the same is done. Now for example, to calculate our discounting factor, WAC is our 10%, cash flow is for year 3, and discounting factor we will be calculating it by 1 divided by 1 plus WAC to the power 3, right? Because we are calculating it for 3 years. Then our PV, which is present value, will be FCFF into 0.751, which is discounting factor, right? So it's like asking what is rupees 100 earned in 3 years worth today, right? So discounting factor is like that only. Then comes expected growth rate, where this is the growth rate of the company's earnings or cash flows based on how much it reinvests and how well it earns on that reinvestment. Calculating that, the formula is expected growth is equals to reinvestment rate into return on capital. To understand it better, we will take an example for the same. So if the company reinvests around 50% of its profit and earns 20% on return on capital, so expected growth rate will be 10. How it is calculated? It is calculated through our company reinvestment into earning. So it will be giving us expected growth rate as 10%, right? So this tells us how fast the business will grow if it continues investing at the current rate and return, right? Then comes our WAC, which is weighted average cost of capital. So WAC is the average return of, average rate return of the company must earn to keep both its lenders and investors happy. So it combines the cost of equity and cost of debt. So the formula for the same is E upon V into RE plus D upon V into RD into 1 minus tax rate. To better understand it, let's take an example. Our equity is 60%, our debt is 40%, return on equity is 12%, and return on debt is 8%, and tax rate we are having 30%. So how to calculate our WAC? So we have calculated our 60% into our rate of return on equity, plus we have taken 40% of our debt into 8% of return on debt, which will be multiplied by 1 minus tax rate. So we will be getting 9.4400 percentage, right? So WACC is the discount rate for valuing FCFF. Lower WACC is equals to higher value, right? Then comes our terminal growth rate, where this is the rate at which the company is expected to grow forever after the projection period. So it should be stable and conservative, right? So for that example is 2% to 4% is common, similar to long-term GDP growth, right? So why it matters? It is used to estimate the terminal value, which often forms 60 to 70% of a company's total valuation. So terminal growth must be less than WACC to make valuation stable, right? Then comes our terminal value, where after projection of 5 to 10 years of FCFF, the company will still exist. Terminal value is the value of all cash flows beyond that period using a perpetuity formula. So formula for the same is same as Gordon growth method. So our terminal value is equals to final year FCFF into 1 plus G divided by WACC minus G. So let's take an example for the same. Our terminal value year 5 FCFF is around 20 lakh and our growth is 3% and our WACC is 10%. So if we want to calculate our terminal value, it will be calculated as 20 lakhs into our 1 plus growth rate divided by our WACC minus our growth rate. So we will be getting 294.3 lakh rupees. So we will be adding this to present value of FCFF to get total firms values, right? So now we will be doing comparable valuation, right? So for doing that, first of all, what we have to do, we have to go to our screener.in and then we have to go down, and here we will be getting our peer comparisons. So in peer comparison, we will be going to our automobiles. So in peer comparison, we will be getting our data for the companies which are operating same as Eicher Motors industry, right? So we got our Maruti Suzuki, M&M, Tata Motors, Bajaj Auto, Hyundai Motors, Eicher Motors, TVS Motor Company, Hero Motor Corp, Ola Electric, Force Motors, Ather Energy, many are there, right? So if I click on this market capitalizations arrow, it will be giving me the market capitalization as per the industry. So lowest is this and highest is for Maruti Suzuki, and Eicher Motors come at 6th place with the market capitalization of 15,145, some heads over here. So these two are the same which I have copied from. Market capitalization I have calculated so as to get my market capitalization actual. So 31.44 is multiplied by CMP, so we will be getting our market capitalization of 4,02,466.72. so it will be same as this, so we can delete this particular table, right? So after that, debt and equity, debt rupees in crores, so it is as it is copy pasted. Then cash ending is also same which we have copy pasted. Now if I want to calculate my debt, so I have calculated it through by my debt rupees in crores by and subtracted it by cash end of the year, which is in crore only. So I am getting 465.90, right? So debt is calculated. Now our EV, which is equity value, enterprise value, sorry. So how to calculate our enterprise value? I have added my market capitalization with my debt and subtracted my cash. So I will be getting my EV as 4,01,997.54, and only one time I will be doing calculation and I will be dragging it till the end, right? Now our EV piece in crore, it is same as what we have calculated, so we can just remove this, right? Then sales rupees in crores, which is as same as we have copy pasted from our screener.in. Now our EV upon EBITDA we got. So now if I want to calculate my EBITDA, what I have done, I have taken my sales into my EV upon EBITDA. So I will be getting my EBITDA as this. So I won't require it. So I will be deleting the same. Okay, so it will be giving me this, right? So I can't delete it. I have to keep it like this. So I can do one thing. I just hide it so that my data will be shown to me as crisp as I want. And here it is my net profit. So it is the same as we have copy pasted, right? Now we will be moving to our comms valuation, right? So I have provided over here amount in crores heading. Then I have given comparable company valuation. So I will do one thing, right? So I have given company name over here, ticker and share price, shares outstanding, equity value, net debt, enterprise value, revenue, EBITDA, net income, EV upon revenue, EV upon EBITDA, and PE ratio, right? In EV revenue, EV, EBITDA and PE, I have written valuation because we have to do valuation for these companies. For financials, I will be taking out my revenue, EBITDA, net income. So just a second, I have to do some formatting over here also, so I can do one thing, right? This is in middle, right? So in market data we have our share price, share outstanding, equity value, net debt, net enterprise value. So in this, what we will be doing, we will be taking our data and linking it with this sheet. Okay, so whatever we have made in our this sheet, we will be linking it to our comms valuation, right? So I have linked it all, right? And my ticker, where you can search it for ticker of the same company. So I have given my tickers for this company. Then coming to my share price, what I have done, I have linked it with my data over here, number of shares, every single thing is provided over here. So first of all, they are asking us that what is the share price, right? So we will be going to this portion, and it is giving us this particular number of equity shares, it is this, and CMP rupees, number of equity shares, it is given over here. Now we'll be linking it with our Eicher Motors, then Maruti Suzuki. Only one time you have to do calculation and you can just copy paste it till the enterprise value, right? For Maruti Suzuki, here we have already linked it, so we just have to do copy pasting till the end. Then share outstanding, it is taking from the data sheet only. Then equity value, how to calculate equity value? So our share price will be multiplied with our share outstanding or vice versa, and then it is dragged it till the end for Force Motors. Then net debt, so we will be going to our data and we will be searching for, yeah, so Aisha Motor is having 195.12 debt, so we will be taking over here, right? And I have decreased the decimal, so you don't have to be worried about where I'm not getting that decimal value. You can just remove it from this function, right? After that, what you have to do, you have to calculate enterprise value, which is equity value plus net debt. So we will be getting enterprise value, and the same function will be applied, that you have to drag it till the end, right? In financials, we have taken revenue, EBITDA and net income. So revenue will be our sales, which we have already taken in our data sheet. We will be linking it here. Then EBITDA also over there we have already calculated, and we just have to do linking over it. And net income is also there of net profit. So this much data is completed for our companies. Now coming to our valuation, what we have to do, we have to do one thing, that we have to fix this enterprise value, which is in H8. We have fixed it, and I have divided my revenue, so that what happens, that if I do calculation, so H will be fixed and the values may differ, right? So once the calculation is done for EV upon revenue, I have copy pasted till the end, right? Now if I want to calculate my EV upon EBITDA, so I will be taking my enterprise value, again doing the partial anchoring, and will be dividing by our EBITDA, which is this, and copy pasting till the end, right? Then calculating our PE, where net income and equity value will be divided, and then we will be getting our PE ratio, right? Then this is completed. We will be going to our mention these 6 heads also, where we will be mentioning high. High is our maximum, right? So we will be taking function of Excel, where we will be typing max and selecting the array, and once enter, and again drag it till the end, right? Then if I want to calculate my 75th percentile, so what I have to do, I have to take quartile, and I have to mention the array, and I want third, like 75 percentile I want data of. Then I have clicked on enter, then I got 4.2 and dragged it till the end. Average and median, you very well know about the function, so I have used average and median for calculating the same. Then coming to our 25th percentile, again the same function will be used which we have used in 75th percentile. So I will be using quartile, and I will be using 1, which is 25 percentile, and enter the same and dragged it till the end, right? For low calculation, it is like minimum. So in this table, what is the minimum value, it will be showing us with this function, and we will be dragging it till the end, right? So this much is completed. I hope you all understood this. Then comes our Aisha Motors comparable valuation. This is the all companies valuation, comparable valuation. Now we will be doing Aisha Motors comparable valuation, where we will be implied enterprise value we will be calculating. So we will be doing calculation through our median into our Aisha Motors revenue. So we have done a partial anchoring over here and done. Then again EV upon EBITDA we have to calculate. So I have taken my median, and I have multiplied it with my EBITDA, because we want to calculate our EV upon EBITDA, right? And after that PE, which is already been calculated, or we can calculate it, right? So we have to make it empty right now, as this is done, right? So net debt we have to again link it with our net debt, which we have already taken, and copy paste it till the end, right? Again, the formatting is right. So after that, implied market value, we have to calculate again the same function. We will be applying implied enterprise value minus our net debt. So we will be getting this value, right? And the same thing will be applied to all the two heads also. Then shares outstanding, we have to link it with our shares outstanding, which we have already have in our data sheet, right? And linking it till the end, right? So if I want to calculate my implied value per share, so what I have to do, I will be dividing my implied market value with my shares outstanding. So I will be getting 1977.3, which is in crores. So make it very clear to you. Then comes the same calculation for all the heads which are there, and then we will be calculating our PE, where we will be adding our implied market value with our net debt, so to get our PE ratio, right? So if we want to check that our book value or share price value is overvalued or undervalued, I have used if function, that if my 1977.3 is more than the share price, less than the share price, so give me undervalued, then if not, then overvalued, right? So it has given me overvalued as my share price is 5512. Okay, let me do it overvalue, and this is our undervalued. So let's see. Yeah, now it is coming correctly. It is undervalued because the share price is 5512 and our EV revenue, which is 1977, 2449 and 4821, which is undervalued, right? So in this, what we have to do, what we understand by this valuation, we understand the data, which means our Eicher Motors is 8.02x EV upon revenue, 0.36 EV upon EBITDA, and PE is 31.9x. Our peer average is around 3.4x, 0.1x, and 24.9x. Peer median is our 2.9x, 0.2x, and 27.9x. Peer high is our 8.0x, 0.4x, and 56.4x. And our peer low is 0.6x, minus 0.3x, and minus 8.9x. So in this, Eicher Motors has the highest EV upon revenue, which is 8.02x, way above P's, right? EV upon EBITDA is high at 0.36, which is this, compared to the average 0.1x, right? From comparing this, Eicher Motors is having good. Then PE is also premium at 31.9x versus 24.9x, right? Then comes our second step, which is calculating implied share price for Eicher Motors. So we reverse engineer Eicher Motors fair value based on peer averages, right? So our EV upon revenue which is our share price is 5512 and we are getting 1977, which is overvalued. 2449 EV upon EBITDA, which is overvalued, and PE ratio is our 4821, which is market price is 5512, is overvalued, right? So in conclusion, based on all these three valuation methods, Eicher Motors is trading at a premium compared to its peers. That means investors might be paying more for the brand, growth expectations, or market confidence, right? So as we have seen today, valuing a company doesn't mean and doesn't need to be intimidating. At its core, it's about asking simple questions that how much company money does the business make? How does it compare to others in the same industry? Am I paying a fair price for it? So whether you are an investor looking for the next opportunity, a business owner evaluating your worth, or a student learning the ropes, valuation is a skill that sharpens your decision making. From calculating fair value using comparable companies to understanding the cash flow, risk, and growth come together in a DCF model, right? So you now have a clear toolkit to assess value with confidence. So thank you for all joining today's webinar. I hope this session made you more comfortable with valuation and gave you clarity, not just about numbers, but also what those numbers represent. So keep exploring, stay curious, and always remember, behind every formula is a story about how businesses work and grow. So if you have any question or would like a Excel or presentation slide, feel free to reach out us. Until next time, stay inspired and financially aware. See you in the next session.